Hello, everyone, and welcome back to the news channel. What we have coming up now is another stock prediction. On this channel, we have 100% accuracy on all stock predictions so far, so that is a pretty good track record. The stock we're going to be talking about today is Disney. What has happened to this company? Such a large, stable business, a great business, has a lot of great products, a lot of great services. They own a lot of other businesses that are a family of businesses. Their theme parks are a great brand. They always fill them up. What's happening to this stock? It's just collapsed. What exactly has happened? And all I have to say is deja vu. I want to read my deja vu. I was talking about another great business in February 9th of last year, and that was Meta. Meta has had a serious meltdown. I mean, at the time when I was talking about it, it was trading at $222. It was probably the most hated stock on the market. You just heard terrible news about it. They were making fun of the name. They were saying young people are not using it. They're losing members. They're spending a lot of money on this metaverse. TikTok is competition for them. And I owned the stock. And there were people fleeing the stock like the plague. So I just calmly looked at the balance sheet. I'm like, why is the stock going down too much? And I didn't see any indications as to why it should go down so much. I mean, they were still hitting it out of the park in most of their growth metrics. I mean, they were doing really well for a company this size, very little debt. I'm like, wait a minute. No, I'm not selling. I'm going to hold. And I did hold. I was in the stock at a higher price. And it only took just a few months later. And then after the 222, it went down even more. The bottom really fell out and hit a low of 88.41. I mean, that is pretty bad. And then what happened? It made a COVID-style V-shaped recovery. I mean, even more powerful than that, unlike most would have expected. And it ended up making a high of $326.20 on July 28th, right? That's a 268% return in 7 months. Okay. Now here we are again. Now it's Disney. You should hear the things that they're saying about this stock. Similar talk to what was going on with Meta when it was trading around $222. Okay. So let's take a listen.
Disney dropping more than 2% today, now trading at lows last seen in March 2020. Remember that? The media giant pulling its programming from Charter Communications cable platforms last night, with the two companies struggling to agree on how much Charter should pay to carry Disney's channels moving forward. And Karen, you're selling Disney stock. Is it on this news? Why?
Yes. Well, I bought it. Remember that Iger interview with David Faber?
Sure.
And Iger sounded pretty sort of downbeat. And so they finally announced their earnings, and the stock sort of did okay-ish. And I thought, all right, maybe it was just sell the rumor, buy the news, all the bad news is out. Well, no, that's not the case. So I dipped my toe in it. I now don't have that toe anymore. It's gone. That was a quick $9. And so I just, I don't know how this is going to shake out, this particular event. But I think, the idea of, well, that's how it's always been done is no longer true. And so I'd rather watch from the sidelines and see how this plays out. Meanwhile, they've got the streaming business, which is losing a bunch of money. And the street loved it, in 21 when money was free and growth was everything that mattered. And that was what generated great stock performance. Well, we're in a very different world now. So just chalk it up to a mistake and just, take my punishment and go home.
Hey, it happens sometimes. Guy, what do you make of Disney right here?
So it's been look, it's a disaster. I'm with Karen. When they reported earnings a few weeks ago and they announced price hikes and the stock was trading 91 in the after hours, I thought, you know what, that might have been it. I mean, the market is finally going to start to see the vision. Here's the turn. This thing should be not off to the races, but it should start to gain some momentum. That was wrong. And there'll be people out there, the go woke, go broke crowd, which is imbecilic, will say it's a function of that. It's really not. It's just a function of a lot of poor decisions, quite frankly, and probably not a great backdrop. So I think at a certain point, I think Karen, Tim, and Steve would agree, there's a valuation play here without question. The problem is they haven't given you any reason to sort of pursue that.
Steve.
Yeah, I threw in the towel a little bit ago as well, and I just got frustrated with seeing other stocks running up through the roof, AI related. But when you look at this, you started on your intro that it's trading around the pandemic low. So they're getting no credit for the parks, which is an absurd amount of money. But to Guy's point, that go woke, go broke. Country's divided 50-50. So does it hurt to the point of it's 100% of the worries? No, but it doesn't help either. So I think they have media issues, they have parks issues, they have pricing issues, and they also have the woke issues that are staring them in the face too. So I think it's a very difficult environment for Disney to actually conduct business in.
So as we back this up, Laura, I think the central point is exactly what you said, that, we're just going to continue to see 5% annual declines and not a big 20% kind of event. Does that still leave Disney as vulnerable as you previously thought, in the sense of, hey, they should just sell to Apple or something to that effect? Or does this give them a little bit stronger ground to stand on for a while?
I think that this is a melting ice cube. And this
Okay, I heard of that. Apple by Disney? I mean, first of all, Apple doesn't just have $400 billion laying around to buy Disney. They're going to have to go into debt to do it. And then the government has to approve it. And even if that did happen, that would be positive for Disney shares, not negative, because the company that usually gets acquired, you see an increase in their share price because their debt gets assumed. So it's good for the acquired companies. I don't understand what kind of analogy that is, but it's not going to happen anyway. Apple's not going to buy Disney. And if they're going to do it, it's certainly not going to be anytime soon. So here we go. It's deja vu. I mean, just listen to this stuff. It's the same thing. The stock had a meltdown. And what do? Rather than hold, they run for the exits, get out. Now, the question is, are they, right? Are they actually selling to get out? Or what they're doing is they're promoting this as such a disaster that a lot of people will sell even more and push the prices down even more. Then they can come around and just pick up the shares at a much lower price. I totally disagree with them. I disagreed with all this media. All right, a lot of people are saying this when this happens with Meta. And look what happened with Meta, a V-shaped recovery. And I was right. All right, the stock hit a high of over $326. And what's really interesting about Disney, if you look at the magnitude of the decline, Meta was at 222, okay? It was at 222 when I made my prediction that this is a good time to even hold or buy, all right? And then it went to a low of 88.41 after that, okay? So that's still a very significant drop, but I did not sell. I held, okay? When you sell and you're already taking a big loss and you keep doing this over and over again with stocks, you're going to go bankrupt. This is not the advice you should be listening to. Don't sell a great business, even when it goes down substantially, because you only need to do that a few times. I mean, if you take, let's say, a 30% loss, even a 30-something% loss, and you take that over 3 times, you're bankrupt. So you got to understand that about stocks and about investments. If it's a great business, you hold onto it and wait for it to turn around. It always does. Now, when I say a great business, of course, if a great business turns into a bad business, then you have to be concerned. But if the fundamentals of the business have not changed, okay, if the structural integrity of the business is the same, their financials, their debt, if everything is the same and the share price is going down because of temporary reasons, you hold on. You hold on to the company. The last thing you want to do is sell. You'll go bankrupt. Don't listen to what they're saying. So the question is Disney a great business, right? Is this the same situation as what we saw in Meta last year? So here's something very interesting. Back in February 9th, the price of Meta was at 222, and it made a low of 88.41. Well, guess what? Disney's all-time high was 203.02, and its most recent low was 79.75 on September 7th. Okay, so look at that. It's almost the same as far as the magnitude of the decline. Nominally, of course, it took Disney a lot longer to get there. But that's actually a good thing, right? It didn't crash as hard as Meta did. Think about that. And if you really look at it, that's a 154% difference. So it's a really big decline in Disney, going from 203.02 the 79, 75, that's 154% in difference, like if it would have gone up from that point. So that's a really big decline. I mean, it's very bad. Now let's see what's going on over here. Is Disney in fact a great business? Well, it has one of the widest of wide economic moats. And that means basically they really don't have much competition. I mean, they are such a giant in the theme parks business. They have over 50% market share in theme parks. And their next closest rival is much, much smaller than they are. I mean, you could just see what happened when the pandemic. Yeah, it was concerning because their parks were closed. So that means zero revenue. But as soon as they opened up, it was just packed like sardines. Disney is a great brand. It has this huge network effect, you know, just like Nike shoes do, and Coca-Cola. People don't give up their brands. They're just going to come back. Now let's see what else they have. That's just part of their business. That's their big, large, very profitable business. Like I said, that's back here again, and it's doing very well. Now, their other business is their streaming business. Now, this is the issue. And here's what's interesting. If you notice during the pandemic, their stock was doing a lot better because people were using their streaming businesses much more. But now, things have opened up. Less people are using it, and now they're running into a lot of CapEx issues. Because the problem with the streaming business is it's a very high cost business, you know, like ESPN, right? For example, they own that. So you're talking about athletes got to get paid and the air rights, all that, to produce everything that they do. They cover a lot of different sports. It's very high CapEx. You need a lot of employees. You got to pay a lot of people. So it's expensive. It's an expensive business. Right now, what all these other companies, all these other entertainment companies that they own, and we're going to go through them right now. You have 21st Century Fox, you have Walt Disney Studios, you got a Hulu. They're going to be buying the last third of that from Comcast. They're going to be spending a lot of money on that, billions of dollars. Marvel, A&E, ABC, National Geographic. I mean, they have their tentacles on almost everything. They're a huge entertainment company, the largest in the world, if you just combine everything. I mean, it's just a gigantic business. So what's the problem? Well, the problem is that there's a transition right now. You see, there are people out there saying, oh, Disney's turning around and restructuring. No, they're not. It's not that bad where they're going through something like that, you know, like a General Electric restructuring. It's not there. It's a transition. Now, what are they transitioning from? They're transitioning from cable TV, like ESPN. They have millions and millions of subscribers. It's a giant entertainment business. But a lot of it is cable TV. Cable TV is slowly dying out. And it's being transitioned into streaming. Okay, that's what's happening right now. Now, to do that is complicated and very expensive because they have to make a lot of deals with broadband companies. Now, what's broadband? Well, you see, the problem that Disney has is they own the entertainment companies, but they have to deliver them to the public. They don't have the method to deliver them that's owned by them. You understand? They're not a broadband company. They don't have the ownership of the delivery. They have to deal with companies that can deliver the entertainment to their customers. So they have to deal with companies like Charter, which is in the news right now, Comcast, Verizon. They're talking about making partnerships with Amazon and Apple. You see, they have to go through third parties. Now, what does that mean? The revenue has to come through a third party for them to get that revenue. So basically, when Charter sells their broadband to customers and their cable TV packages, the customers pay Charter, and then Charter pays Disney. So they give Disney a cut of what they get paid from the customer. And that's one of the high expenses that Disney has. They have to constantly make deals with all these broadband companies. They recently got into a fight with Charter because they couldn't agree to a payment agreement and how much they should get paid. They said, we're going to leave this out, you know, leave out Disney Plus and you can keep this. So they got into this whole disagreement. And it happened right before a major production that was going to happen, some sporting events. So Disney didn't want to prevent customers from seeing it because they were afraid of the backlash. So they came up with some deal. So you see, this is the problem. They have to find a way maybe to form some sort of a long-term contract agreement where they don't have to run into these problems. But the problem is, like I said, they have to constantly make these partnerships. Then there's something else they have to put into the mix and figure out like how they're going to put ads, right, which will also help them generate revenue besides selling subscriptions, which is what Disney has. You see the benefit that Disney has over a company like Meta or Google. They rely a lot less on advertising. Most of their revenue is coming from subscriptions. So people subscribe to Disney Plus, they subscribe to ESPN. It's money just coming in. The ads is something on the side. So that's how they also make money. So it's actually a benefit if you think about it. So they have two ways to making money. They have products and services that they sell, which especially includes their theme parks. So right now it's costing them a lot of money because they have to transition. They have to transition from the cable TV business into streaming. And as you see, they have to deal with all these broadband companies to figure out some sort of an agreement that they can make of how much they can get from these broadband companies to generate revenue. So it's expensive, it's time consuming. Of course, a lot of these businesses require a lot of overhead, especially their other businesses. And as you know, that since they're a content creator, there's some sort of a strike going on now. So they have to figure that out when the strike's going to end, how much they're going to have to pay them. Very high CapEx. A lot of things are happening at once. And this is what's weighing down on their profits. But you got to understand something. If you want to get something at a good value, something like this has to happen, right? Something like this has to happen for there to be some short-term pain for the stock price to go down so you can pick it up at a good price. But now they have another problem. This whole thing that went on in Florida where they got involved politically, I think it was just a huge mistake. Companies should never be political. They should never comment on things. Stay out of it. You just say you're apolitical. Don't get involved. Something happens politically, but they didn't. They got into some legal case, big argument with the governor in Florida, and this has also weighed on their shares. It has. People have sold it. You just see what's going on with Target. Their shares got hit with Bud Light. Look what happened to their shares, right? They really got hit hard. For some companies, it can be really bad. Now, I think this is just short term. It's going to blow over. And you got to understand something. Even if you don't like what they do politically, again, it's amazing how similar it is with Meta, right? The other thing that was also weighing on their shares were people didn't like what was going on with censorship in media. So that was weighing on their shares too with Meta, with the censorship. So it's the same thing here. It's also political, right? They don't like the stance that Disney took. People didn't like it, and it's weighing on their shares. But again, this is short term. People are going to forget about that. But it's built in to the suppression of their shares. So it's a confluence of things which are forcing the shares to be so low right now. They shouldn't be at this level. All you have to do is look at that balance sheet. Nothing has really changed. Things have actually improved, especially with their theme parks. You can see the double-digit growth. You can see that the free cash flow is turning positive once again in the recent few quarters. So you actually see things improving, yet the share price still continues to go down. So you know that it's temporary. You know all the things that I just mentioned here could be affecting the business. And there's other things that they're doing, just like Meta was doing. They're laying off workers. They're reducing their CapEx. They're reducing their expenditures. So that's a good thing. Buying back shares, that's another thing. You see these activists getting involved, right, in the company. That means they're going to start buying back shares. So I just want to tell you again, even if you don't like what they're doing politically, don't let that get in the way of your investment goals. For an investor, your goal is not to say, oh, I'm a proud shareholder of this company. No, I could care less. My goal to invest is to buy something at a price where it will go up and then I can sell it at a higher price. That's how you recognize a profit. You buy low and you sell high. I don't care what it is. It has nothing to do with the prestige and the pride of owning shares. That has nothing to do with it as an investor. Your job as an investor, it's your hard-earned money. You have to get in on a price where you think it's going to increase at a higher price in a specific period of time where you can profit, emphasize in a safe manner, not buy some junk garbage company where you're going to lose all your money. Now, the question is Disney a great business? Yes, it's a fantastic business. It's one of the best businesses in the world. As you can just see, it's the largest entertainment company out there. There's something else I want to mention, which is also weighing on the stock. People saying, oh, well, look at the S&P this year. It's doing so well. Look at the stock market. It's really, really rising strongly. It's in a bull market, and Disney shares have done terrible. Well, you think it's just Disney? No, it's the entertainment sector itself. Look at Paramount. Look at Warner Brothers. They're not doing well either. Their shares have done worse than Disney. And they're competitors of Disney. They're not doing well because they're involved in the streaming business. It's not doing well right now. So even if you remember last year, there were some tech companies that were doing better than the others, but their share prices also went down because when people sell, they sell the whole sector. That's the way it works in the stock market. Disney is in a poor performing sector, which is also weighing on its shares, okay? That changes. You can have a bad sector one year, right? And other sectors are doing well. Then the following year, those sectors are not doing well. And then the entertainment sector is doing well. It just changes, just like what happened with tech last year. You saw energy doing well. And now you see that tech has done really well this year and has outperformed. So it's the same thing here. That's another thing that's also affecting it. There's a few other things that they're doing, which is also going to increase their revenue. They're raising prices, and they're also cracking down on password sharing. As you saw with Netflix, they did really well. After they did that, after they cracked down on the password sharing, their stock price started to perform much better. So they're doing the right things. It's just a matter of path to profitability. Why is the share prices going down? Well, we know why. Investors are very impatient. They don't have patience to wait around. They see things going bad, they sell, and they get out. It's going to turn around. You could just clearly see people are not going to stop watching sports, right? Americans need their bread in circuses. I mean, they have their bread now, and their circuses is their sports. They have to have it. ESPN is the #1 provider of sports on TV. So, I mean, they own it. They own that company. It's just a matter of them getting into streaming, making the proper partnerships that they have to make between all these broadband companies to deliver the content out to the customer. And that's the path to profitability. It's that simple. You see, you have to understand it's a symbiotic relationship. They both need each other. Broadband needs Disney, and Disney needs broadband. So they're going to have to come to some agreement. And that means they're going to be profitable. That's the bottom line. Will the customer have to pay for it? That's ultimately what's going to happen. Prices will go up to a point where Disney is going to be profitable enough to convert the cable TV business into streaming, and that's where your profits are. So it's going to happen. Now, with that all being said, how do we approach this? Well, the price right now is in the low 80s level. What you can really do is one thing you could do is dollar cost averaging. You could buy some shares, and then as it goes lower, continue to buy more and more. Could the price go lower than it is now? Sure, it can. I mean, it's in the low 80s. It went even below 80. It can go down even more, but I don't think it can go down that much more, barring any collapse in the market. Then everything goes down. So you just have to hunker down and wait. That can make it even worse, but I don't know when that's going to happen or if that's going to happen. There's no indication it is. The market is really strong this year. And of course, some stocks buck the trend. I mean, look at Walmart, 2008. An entertainment company can do it. People always need entertainment. So it's really hard to tell what's going to happen. What's good about this business, like I said, they're not too reliant on advertising, which is very good. You see a company like I mentioned, Meta, they rely tremendously on advertising, and Disney doesn't. Disney gets a lot of their revenue from subscriptions. They're streaming businesses. You have to subscribe and pay to watch them. And of course, their theme parks, you have to pay to get in. So I think they have less exposure from economic downturn than a company that relies more on ads. And also the tech industry is vulnerable to higher interest rates because they borrow money to fuel growth. These are growth businesses. Even large tech companies are growing. So I think this is a safe investment. I think this company is going to go up substantially, especially in the very low 80s, high 70s. I would put a target of a 20% increase I would say maybe in the next year, maybe a little longer, maybe less. Now, how do you enter this? Well, you could do dollar cost averaging. You could buy some shares now, wait for it to go down a little bit more, buy some more. Don't buy all in at once. The other thing you could do is possibly just sell some puts. Of course, with puts, you're going to have an exposure of 100 shares. So it depends on your account size, right? You're going to have to, I mean, if you're buying it in the low 80s, you're looking at over $8,000 that you're going to have to cover. I don't believe in trading on margin. This is a long-term position. There's no stop loss here, of course. So that might be something to look at. Of course, the profit potential is limited because the stock can take off and, you know, basically never hit your strike. But it could be a good way to make some short-term money. You could just set your strikes somewhere below the price. If it's close enough, it should get hit. Be patient. I would like to possibly look at a target in the low 80s, maybe 81, 82, maybe lower. Put like a limit order to get in, or set your strikes at about 81 or 82. And you could do weeklies. I mean, you could just basically sell weekly puts. It could be a really interesting way to go about it. This is not a recommendation to buy it. I'm just making a prediction here. What you decide to do with your portfolio is really your decision. But my prediction is this stock is going to go up substantially from where it is now. So I would like to know what you think. What do you think about Disney? What do you think about the business? Is this a company that where you think there is potential for the stock to go up? Where you think it's going to go? I'd like to know your thoughts. Please leave your comments. Please like up this video. Please subscribe. And thank you for tuning in.